Well, thank you everyone for being on tonight's asset protection webinar. We are delighted to have you, and thank you for being here on time. That makes a big difference. We appreciate that. All right, so we're so excited about this. This CARES Act, and combined with the Trump tax law, is a game changer for so many people, but so few people understand it. And so we're delighted to have former senior trial attorney Scott Estill with us. Scott is, if you've listened to him in the past, just an incredible wealth of information, and we are delighted to have him on board. So a couple housekeeping things real quick. For those of you who are just joining us for the first time, this is part of a huge webinar series. It's been going on almost 10 years now. In March, we had Dr. William Danko on talking about how to become richer than a willed millionaire, and great talk on ethics and morals and friendship, and great webinar. Mike Koval, one of the best stock traders in the nation, Toby Mathis, attorney from Anderson Law Group, was talking about the benefits of the CARES Act. Cost segregation, we had the president of Cost Seg Authority on, brilliant on how real estate investors can take advantage of the CARES Act and the Trump tax law. And so we've got a nice little webinar series lined up in the future. Pay attention to these webinars because not everyone will apply to you, but so many do. We've got three-day summits coming up this year, one in Phoenix in July. We've got the Orlando one, and then we've got the Las Vegas one. And we are doing everything that we can do to bring in social distancing. We're in a large ballroom. We were separating spaces. We're doing everything that we can do to keep everyone safe. We know the airlines I've traveled several times in the last month. I went to Indianapolis. I've been to Phoenix. And been in Detroit, and the airlines are taking special precautions. Make sure that you are as well, and we will social distance as best we can, but also teach incredible asset protection. If you'd like a sample, or it's posted on our website. Go to protectwealth.com. We've got that, and then for those of you, we are still tentative on the cruise. We haven't canceled it, but we also aren't promoting it heavily. But for those of you who have signed up, we're I don't know. It's not a great time right now, as you know, to promote a cruise. But when we do, oh, what an incredible opportunity it is to meet one-on-one with instructors and some of the greatest millionaire trainers in the nation. So with that, I did want to talk to you about the summit in Vegas, or I'm sorry, Phoenix, right there. And that is the hotel. We've got to do something different in that we've got over 300 people registered who have told us they want to come, but we really have to reduce the class size. And so we're asking that you make your hotel reservation. Check your emails if you've registered for Phoenix. We are requiring that you either register at the hotel that confirms that you're coming. There's a $99 deposit that will confirm your attendance, or you can send us your travel details. But we really have to confirm that you're attending. And those are very simple ways that hopefully that we can accomplish that and know who's coming. So with that, let's talk about taxes. That's what you came for. And with a quick disclaimer, the principles that Scott will teach tonight in the Q&A section afterwards, not everything in here will apply to you. That's one of the reasons we invite you to the summit, to give you a chance to sit down one-on-one. But whether you sit down with our professionals or someone else, don't go into these concepts. These new laws are very complex, and we don't want you to go off half-cocked thinking that everything applies to you when maybe it doesn't. So we encourage you to get some professional help, and that will be available at the 3-day summits. Anyway, with that, Scott, I'm so delighted you're here, and thank you so much for taking time. For those of you who've heard Scott before on our stage or elsewhere, you know that he is just an incredible wealth of information. And Scott, would you agree that this is not a simple new tax law? This is one of the most complex pieces of work I've ever laid my eyes on. What are your thoughts?
Yeah, absolutely. I mean, I've been reading it for the last, I don't know, couple months or so, trying to figure it all out. And it's, you know, some of it seems pretty simple, but some of the things that should be simple are very complicated. So, you know, it's, again, we're going in this without really knowing exactly what we can and can't do, but, you know, we'll do our best here.
Well, with no court cases on this and no private letter rulings, we kind of have to go just by what's written in the tax law. So Scott, we're going to turn the time over to you, and we'll leave a little time if you have questions. We'll probably go through your questions at the end. And so if you have questions, I wouldn't type them in now. Scott has a really logical presentation prepared for you. So let's go through, but write down your questions and then type them in at the end, and we'll get to as many as we can before the time is up. So Scott, delighted to have you here. Thanks for being here.
Thank you, Don. Always my pleasure. And tonight's webinar here is going to be a little different than ones I've done in the past. And the reason I say that is because this law is brand new. As you can see, we're less than 3 months old on it. Pretty unanimous as far as passing the House, pretty overwhelmingly unanimous in the Senate. But I think the fourth bullet point, expect additional tax bills in 2020. I think that's going to be a really, really key point in that we're not done yet. And, you know, I think, as Don mentioned too, we don't have any court cases. We don't have any private letter rulings. We don't have any regulations. We don't have anything here other than what the law is and then what people like myself have interpreted it to be. So for tonight, what I really want to focus on, obviously, is the businesses and the individuals and what are the provisions there. But please understand that these are my interpretations of some of these laws. And so, again, this becomes even more critical now that before you implement anything, let's make sure, again, that it applies to you. As you know, again, not everything that I'm going to be talking about here tonight applies to everybody, certainly on this webinar. But, you know, we do want to be in a situation where if we can use it, let's do it. Let's go to our tax professionals and let's make this work for us. So we're going to start here tonight with the first part of the economic stimulus program. And this program, I mean, everybody's kind of heard of, oh, I can get a $1,200 check, maybe $2,400 if I'm married. I don't know if I have to pay taxes. I don't know what the deal is with this. So let's start with what I consider to be the easy part. And this is not easy. So the first part here is maximum we can get $1,200 a person. This is not taxable income, meaning that if I receive $1,200, or let's say myself and my spouse receive $2,400, we do not need to report this on our tax return. So this is not income. So that's going to be our payment amount. And so we know maximum $1,200 per person, but who qualifies? And not everybody in the United States qualifies. So number one, we live in the U.S. and we have a Social Security number. Okay, pretty straightforward. Cannot be an adult dependent. What does that mean? Well, that means, let's say that I'm 50 years old, but my children or my parents maybe are taking care of me for a disability or for some other reason. I would be an adult dependent, and at that point, I would not qualify. I file a tax return in 18 or 19. Now, this is not necessarily the case because it is possible to get the stimulus payment without filing a tax return. But for those who do file the return, you can get this payment automatically. You have to be at least 18 years old, and you can't be claimed as a dependent on your parents' return. So those are some of the eligible individuals as to who qualifies for this particular payment. Now, one other payment that's involved here, and this is for dependent children aged 16 and under. We may qualify for a one-time payment of up to $500. Again, this one-time payment is not taxable income. So this is our dependent payment part, and we also then need to take a look at how much money we're making. And again, this is where we're getting into different standards. Of course, we can't make the tax law simple. Seems like it anyways. We've got to put all these different checks and balances in there, all these different conditions. And here's our first condition here. Don't make too much money. So I've got 2018 and 19 on there. Can also apply to 2020 as well. But these rules get a little bit strange as far as how it's going to be determined. So if you're single and your adjusted gross income, so this is not taxable income, but this is adjusted gross income, was less than 75 grand, you're going to receive the full 1,200 bucks. And if you're married and you file a joint return with your spouse, we double these amounts. So I'm married and I file a joint return, and my adjusted gross income is 120,000. I qualify, we qualify, I guess I should say. And at that point, we would get the full 2,400. Okay, so don't make too much money. So what if you do? What if you make more than 75,000 or more than 150? Well, there's a phase-out range, and this amount for single individuals is the 75,000 to 99,000. Again, this is adjusted gross income, not taxable income, meaning that we don't get any tax deductions here before we compute this amount. And again, married, filing a joint return, we just double these amounts. So if we're in this phase-out amount, then we're going to get something more than zero and less than 1,200, or 2,400 if we're married, filing joint. So how does this play out? Well, you know, as far as what the law says, your check is going to be reduced by $5 for every $100 more in AGI that you make. So what does this mean, really? Well, it means that if you're single and you make more than 99 grand, or double that if you're married, you will not qualify for this check. So situation, I'm single, I make 100,000 a year in adjusted gross income, I do not get this check. All right, so how does this play out? Well, let's look at example 1 here. And so we have Noah and Emma, married, file a joint return, and they have 2 young children. 2018, their AGI was 140,000. This amount is less than the full phase-out amount. So what does it mean? Well, Noah and Emma will each qualify for a $1,200 payment, and each child, given that they're minor children, 16 or under, are also going to qualify for a $500 payment for each of them. So what does this mean? Well, the family is going to get a $3,400 stimulus check, and that $3,400 is not taxable income. Now, when you look at this amount, this $3,400, what it really is an advanced tax credit. And so if for, let's say, some reason Noah and Emma didn't receive this $3,400 check for the family, they would be able to claim it on their tax return and get it at that point. And so that's something that I don't think is really well publicized. And here's a way to look at it as far as who does and who does not receive the check. So here we have Jose, he's single, AGI of 75 grand, and he's got 10,000 bucks withheld from his paychecks. He qualifies for the check because his income was low, right? His adjusted gross income in AGI was $60,000 in 18. So he receives the check. So this is what his tax return looks like in 2020 when he files this time next year, let's say. Adjusted gross income, he doesn't itemize, so he has this taxable income of 62 grand. pays his income tax, takes out his withholdings, and he's going to get this refund check of $393. He's already received his $1,200 stimulus check. What though if Jose did not get the check? Let's say he didn't file for 2018, or the IRS for whatever reason didn't send it. Well, in that case, we would just go ahead and file the exact same return. So if you notice here, income tax due is the same, the taxes paid is the same, but since he didn't get the check, say currently, he can then put the credit payment on the return. So when we go back a slide here, the amount of the taxes, everything is identical. The only difference is in example 2, he receives the check today, so he doesn't get a $1,200 credit on the return, where in this case, he didn't receive the check and he gets the credit. So either way, Jose in this case is going to get the $1,200 credit. It's just a question of, is he going to get that in the form of a check or a debit card, prepaid card like they're sending out now, or will it be a credit on the return, which in this case would bump up his actual refund. So looking at this, who doesn't qualify for this? Again, you make too much money, quote unquote, you don't qualify, you don't have a social security number. If you owe back child support, they'll take the stimulus check and apply it to the child support. So you won't receive it in that situation. Also, the last bullet point, kind of an interesting factor, but who gets the $500 per child check when you're in a situation where you don't have a married situation, right? Or you have custody issues here. And whoever claims the child on the 19 return is going to get the $500 check. So obviously, a little luck factor involved there for any divorced taxpayers. Other ones who don't qualify, and this is kind of a strange one. College students, I suppose I get that one in the sense that someone else is claiming you as a dependent, so therefore you're not eligible. But to eliminate that person from the parents when they are paying for the college expenses seems to be a little strange. Even stranger, in my opinion, is that 17-year-olds do not qualify for some reason. So you don't get the $500 check, and they can't claim the $1,200 payment. Others who don't qualify, any seniors or disabled adults, if somebody else claims them as a dependent. So if I'm a senior citizen and let's say my son or daughter is claiming me as a dependent, then I don't qualify for the payment. Also, one final point here, any children that are born in 2020 are not going to be eligible for the credit now, but you will get the $500 credit when taxes are filed next year. Okay, so another way that you'll get the credit is just a question of when will you receive the funds. In this slide here from my favorite, the Tax Foundation, independent group, so not political at all, and we can take a look at if you're single, your maximum there is 1,200 with that sort of light green color, and going all the way up to the darker blue color with the married filer with 2 children, and you can see how the income, then the phase outs come into play as to how much you can make and be able to get some sort of a payment amount. But anyways, again, the complexity comes in right about now. And that happens if, what if I qualify in 1 year, but if I don't in another year? So I'm a single person and I make less than the maximum 75 grand in 2018, and I qualify for the $1,200 check. In 2019, I earned too much. I am not required to pay this back. So what does this mean? Well, IRS is going to look at our 2019 return first. And if we haven't filed the 19 return, then they're going to go to 2018. So in this instance, it would have been better if I want to receive this $1,200 today to hold off filing my 19 return, make sure that the 2018 return is the one that is used for the calculation of the stimulus payment. Once I receive the $1,200 check, then I can file 19 and I don't have to pay the money back. If I don't do it that way, I might have to wait for a credit to appear before I can get the money back, so to speak. So if our income goes up, we don't have to pay it back. What if our income goes down, though? In 2018, I earned, quote unquote, too much. 2019, I did not earn, quote unquote, too much, right? I'm in the sweet spot here. I'm under that amount that I need to be able to get the full check. In that case, then, I'm going to get the full amount, the $1,200, on my 20 tax return. So in this case, if either year I earn less than the minimum amount, okay, then I'm going to qualify for the $1,200 check. And if I don't get the $1,200 check today, I can take it as a refundable tax credit on my 2020 tax return. So again, you're going to either get the check now or you're going to get it sometime in 2021. And with most things like this, obviously, if we can get it today and put that money to use, the sooner the better. Now, the IRS here, if you want to know why we don't have to repay this, IRS here has given us this information here on their coronavirus page that they've set up. And it's actually a pretty good web page on the irs.gov in that they go through a lot of different questions. But the repayment was one that I was concerned about initially. Is the IRS going to give us the money and then take it away, either by making us pay it back at tax time or by returning the money now? And the answer clearly is no. So if you've got the repayment, you get to keep it. Here's a few more examples to show how this can be played out. 2018, Caitlin is claimed as a dependent on her parents' tax return. So if we look at the third line here, Caitlin receives no payment. Right? She's a dependent on her return. She doesn't get the payment. Now, the parents may get a $500 payment depending on how old Caitlin is, but let's say Caitlin is 17 or 18, or maybe she's 22 and graduates college. So in 2019, she graduates from high school, college, whatever, locates a job, and is no longer dependent on her parents. So in 2019, now Caitlin is entitled to a payment of up to $1,200. And if she doesn't make, again, the quote-unquote too much, she will get the full $1,200. So situations change. 18, she's not entitled to it. 19, she is. Look at another situation here. In 18, we have a married couple, no children, and they have a big adjusted gross income of $300K. They do not get a stimulus payment. But in 2019, Selma takes a leave from work, and the couple has a child. Their AGI drops quite a bit because Selma isn't working, and so now they do qualify. So if we look at 18, the $300,000 of income they made, they get nothing. But on 19, they're now entitled to this payment of almost $3,000. They each get the $1,200, plus they're going to get a $500 credit for the child. So, and again, that $22,900 there, they may be taking that as a credit on their 2020 tax return. So one way or the other here, Mo and Selma are going to get this $2,900. Again, just simply a question of timing. When will they get it? Now let's take a look at this situation here. Mo and Selma, they're married, have a 16-year-old son. Their AGI is 145. Now, in 19, their child is a year older, but they have the same AGI. In 2018, they would get the stimulus payment based upon Andy here, the 16-year-old son. So they would get $2,900. But based upon 19, now that Andy is 17, he no longer qualifies for the $500. So if we can delay filing 2019 until the $2,900 payment has been received, that's going to be the best of all worlds, because we'll get the payment here based on 18 rather than 19. And remember as well that 2019 tax return is not due until July 15th this year. And with extensions, we can even get more time, but delay the filing if it's going to put you in a better situation today to receive extra money. Okay, that's in a nutshell the $1,200 and $2,400 stimulus payments and how that works. Let's look at some of the tax benefits now for businesses. And I'm not going to get into like some of the paycheck protection programs and some of the other loan opportunities, but I would suggest that anybody that did not see the webinar, it was about a month ago with Toby Mathis at Anderson, you need to watch or listen to that webinar. I learned quite a bit from that one, and I definitely don't have the expertise in that part of the tax law that Toby does. So it was really, really well done, in my opinion, and go to that webinar to get that information, because there's a lot of the loan programs that are really, really valuable. Let's look, though, at what the CARES Act does with employees and this employee retention credit. So this is going to be a maximum credit of $5,000 per employee. And this is a refundable payroll tax credit. So we're talking about not income taxes, but payroll taxes. So for those that have employees, this is our 941 taxes. This is Social Security and Medicare. And what this refundable credit does is it takes all of the wages and you can get a 50% credit for some of these wages that were paid. So the maximum credit is up to $10,000 per employee of wages. Half of that is a maximum of $5,000. So what does this mean? Well, it means basically that if I paid $10,000 to some employee, I can then receive a $5,000 tax credit for employee retention of that particular employee. So what do I have to do? What's my, eligibility here? This applies to for-profits or nonprofits. That if those business operations, and again, for-profit or nonprofit, has been suspended either in full or in part as a result of some government quarantine order. Also, if your business has experienced a greater than 50% reduction in quarterly gross receipts, you are an eligible employer. So maybe in a situation like my business, maybe my business didn't get shut down, so I can go work at home. But in one of the quarters in 2019, I made $10,000, and in the same quarter of 20, I made $2,000. So I had a greater than 50% reduction in my gross receipts. Therefore, I'm now eligible. Notice, though, the last bullet point, and this is where the sort of getting into the Toby Mathis webinar I was just talking about. But if you're getting a small business interruption loan or one of these other loans in relation to the CARES Act that Toby talked about, you will not qualify for this credit. So we want to make sure that if you're going to get the loans, that the loans are going to be more valuable to you than would this particular credit. Or the flip side, if you take the credit, you're not going to be able to get the loan. So make sure you understand how those two play out for your particular business. Other eligible employee issues here. If the business has 100 employees or less, all employees are included. If it's more than 100 employees, you have to look at those who are furloughed. For most of us on this call, unless you happen to be an employee, most of the businesses that I work with have 100 employees or less. So that's not typically going to be an issue, and the credit will be available. Notice again, though, at the bottom, we can't utilize the work opportunity credit along with this particular credit. So it's one or the other, no double dipping on the tax credits. Paid sick leave for workers also comes into play, so we can receive this 80 hours of paid sick leave, and that has to do with when we have childcare issues or when the schools are closed, and this obviously can be a state-by-state or city-by-city issue depending on how all the localities have dealt with the COVID-19 issues. Paid sick leave, we can get 100% reimbursement for this, including health insurance costs, no payroll tax liability, and this applies to self-employed individuals. So what does it all mean? Well, if I'm an employer, let's say I'm an S Corp or a C Corp or maybe an LLC that's taxed as a partnership or whatever, I had that, and I have paid sick leave for my employees, I can now get 100% reimbursement for this. Let's say I'm a Schedule C sole proprietor. Maybe I have an LLC that's disregarded, or I haven't set up my entity yet. So therefore, I'm not an employee. My self-employment tax issues can be also reduced as far as disemployment or reimbursement goes. So again, that's what this slide shows, that we can use it to reduce estimated tax payments. And I've seen some misinformation on the web about this, but it is available to self-employed individuals. So it does not have to be a W-2 paycheck. All right, and I think that's some confusion that I've looked at, and I'm pretty confident, actually very confident, that my impression on this, my opinion is correct. So self-employed individuals do qualify. If you've got less than 50 employees, you can get an exemption from this requirement. And, this is really pretty normal for very small businesses, in that the government and the IRS in this situation is not going to force you to do something where, as the second bullet point says, where the viability of the business is threatened. So if I have 3 or 4 employees, and if I have to follow these laws, I'm going to lose my business. In other words, I'm going to go under by having to comply. Then at that point, I'm certainly not required. I get an exemption from this. So let's look at how this plays out. So I'm an eligible employer, meaning I have one of these issues, the gross receipts test or the quarantine test, and I pay out $5,000 in sick leave. Now, when I look at all of my payroll taxes for any of my employees, my deposit requirement is $9,000. So this would include any income taxes, anything that was withheld from my employees. Payroll taxes I should be making a deposit, $9,000 bucks, but I get a $5,000 credit here. And so in effect here, I should have been making a $9,000 deposit if I would have in, let's say 2019. But in 2020, with this credit for the qualified leave, I now make a deposit of $4,000. So it's really putting $5,000 in my pocket here, however you want to look at it. And this is something that we need to take a look at, we meaning businesses. Same type of situation here, where what if instead of paying $5,000 in qualified sick leave, I pay $10,000? So I still have that same $9,000 hypothetical here, but in this case, my credit exceeds what my deposit should have been. And so in this case, I can actually get an advance credit, an advance refund of $1,000, or use that in the next quarter. So this is a credit that can be used, and also all businesses should be looking at this, because I'm going to jump back a couple slides here. And when we're really looking at this, most businesses are going to qualify for this. Because the greater than 50% reduction is a fairly easy standard to overcome. Many businesses had a big drop in their quarterly receipts. May have been the first quarter of this year if March was a particularly bad month. But, in April, May, and June, many businesses are down 50%. And I think it would also be very easy for some businesses, let's say, a business that does a service-related business. I could have a situation where, let's say in the second quarter last year, I billed $100,000. I could decide not to bill much in the second quarter of this year, keep my gross receipts under $50,000, right, under 50% of last year, and qualify for the credit. So there is planning here that can be done that is going to permit me to take advantage of this particular tax provision. Okay, so I'm going to jump ahead now. Where was I? To this slide here. And this is just another way that we can take advantage of some of these laws. Now, one of the situations is that the employer share of the Social Security tax. So this whole tax is 12.4%, and the employer and the employee each pay half of it. So that's the FICA guy on the W-2. So the employer share, the 6.2% of the amounts, can be deferred, and it can be deferred by 2 years. So what does this mean? Again, 6.2 of it, let's say that that was $10,000. I could pay half of it in 21 and the other half in 22, and I don't have to pay this amount in 2020. So we're trying again, the law is trying to get us to increase cash flow here. Notice though, bullet point 3, the PPP loans. If you get one of the PPP loans, you are not going to be able to use this delay of payments. So here's how it plays out. We have Homer Inc. Has $100,000 in wages here, and thus it has this 15.3% of employment taxes that it needs to pay. Half of it for the employer, half for the employee. And of course, in that 15.3% is our employer share of the Social Security taxes, or that 6.2% that I had on the previous slide. So here's one of the options of what Homer Inc. can do. The 15.3% of 100K is the 15,300. The 6.2% of that 100,000 is 6,200. So this business here would have to deposit $9,100 sometime this year, sometime in 2020. But it can take that other 6,200 that it should have to deposit in 2020, if this was a normal year, so to speak. But it can take that and defer it and put half of it in 21 and pay the other half in 22. So in this particular situation, we could pay $9,100 in 2020, $3,100 in 21, and $3,100 in 22, giving us increased cash flow. Now, obviously, if that $100,000 was $1 million or some other number, these numbers can be quite a bit higher, and might see a big difference cash flow wise as to how this should all play out. All right, another huge opportunity for planning for business owners. C corporations, net operating losses. This was one of the tax planning opportunities that we used quite a bit in the past. And what I mean by that is that in the past 20 or so years that I've been teaching taxes, live events, webinars, whatever, net operating losses for C corporations always came into play. Different tax rates, there might be ways that we can go backwards or forwards with losses to really maximize these potential deductions. 2018 changed everything, and the Trump tax laws eliminated net operating losses going backwards, meaning that if you had a loss in 18 or 19 or 20 or 21 or any of these years, you could take the loss, but it had to go forward. And if you had the loss, you could only use 80% of it, so that even if you had a loss in 1 year, you couldn't use it to totally zero out future income. This is what the law was. Here's what it is now. So the CARES Act says if you have an NOL, a net operating loss, in 18, 19, or 20, we can now fully deduct it. We don't have this 80% limitation. So now it's 100% deductible, which is the way it was in the past. Also, and this is the big one, the net operating losses that could not be carried back because of the 2018 tax law has been amended, and now we can carry it back. And not only can we, but if we're going to amend and look at the losses at all, we have to carry them back unless we choose not to. So we can claim refunds. So the 5-year carryback rules are mandatory. So if you're deciding to go back with any losses, you have to go back 5 years and then bring them forward. But it's a huge tax planning opportunity because we can decide if we want to go back or if we want to go forward. And that's a big decision that is going to be, I don't know, I'd say very different depending on your particular situation. So why would we not want to carry them back? Well, several different possibilities, as these little check marks show. We may have had losses in the past, and so carrying them back to the past is only going to increase those losses, and really no reason to do that. Maybe we had very limited income in the past, so it didn't really do much as far as taking it back. Or maybe we expect to have a larger taxable income in the future, in which case these losses could be more valuable. Could be other potential tax strategy decisions as well, but I think the big one is checkpoint number 4. Expects tax rates to rise in the future, and thus the loss would be worth more. If you believe that the current 21% flat tax is going to change and it's going to go up, let's say that we're looking at it going from 21 to 25%, that loss, it can now be used to absorb income at 25% rather than 21%, and we get a bigger bang for the buck with the loss. Again, I'm expecting tax rates for C Corps to go up in the future, and when I say the future, I'm expecting that that could be within the next couple years. So again, that's a guess on my part, but I don't think it's too much of a unreasonable stretch there to assume that this is going to go up. So we have to look at our situation and determine which way we want to go. If we don't want to go back, though, we have to make that election to basically waive the carryback. And as I've highlighted here, this election is irrevocable. So make sure that if you don't want to go back on the carryback losses, that whoever's preparing your tax return understands this election requirement. And you may want to go back to this webinar at some point so that you can make sure that he or she knows this Revenue Procedure 2020-24. This is how we go about doing it. And again, there could be many situations where this may be appropriate. So let's take a look at this particular corporation. So we have XYZ, C Corp, begins about, what, 8 years ago or so, and this is what it looked like. In 2012, it lost money its first year. 2013, it happened to make the same amount of money. Given the way the laws were back then, we can use the entire loss from 12 to zero out 13's income. So we haven't paid any taxes yet, but 14, 15, 16, 17, all of those years, we paid taxes. We had a net income, and we paid anything from, $1,500 to a little over 40 grand of income, for taxes, excuse me. In 2018, we had this big loss. So of course, we don't pay anything in tax. But the 2018 tax law said that we can't carry this back. So we're stuck with all of these tax bills in the right column because we have this loss that can only be used in 19 and 20. Of course, we haven't filed those returns yet as of now. But the new tax law allows us this change. So what is our opportunity here? The opportunity is that we can amend the 2018 return. So if you notice the last slide and this slide, everything is exactly the same as far as our taxable income goes. So I'm not amending the 2018 return to maybe report more deductions or less income or whatever. My taxable income stayed the same. But what I've done here is I've been able to amend the return and claim a loss carryback. So what that's going to do is allow me to get an immediate refund of the 3 taxes paid and that are in that purplish color on the right. So I'm going to get the $1,500, the $7,500, and the $13,750, total it up to $22,750. I'm going to get an immediate refund of those amounts as soon as my amended return is processed. So again, all I've done here from the previous slide to this one is taken the change in the tax law where we go back here and I get nothing. I'm going to look at just using the 135 loss to hopefully zero out income in 19 or 20, to amending that 18 return and pulling 22 grand back into my business account. So that's one of the options that is available to us. Of course, I just mentioned that we don't have to do this if we don't want to. So we can make the decision to leave everything alone and not carry back the 2018 loss. So why would we do that? again, let me go back here. Well, maybe our income in 2019 is $1 million. And we look at the tax rates, and we're gonna end up paying $210,000 in tax, and maybe the $135,000 of income loss would be better to carry forward. Again, this is an individual business by business decision. Let's look at this case here. Brand new corporation. Go ahead, and we had a nice taxable income in 18 and in 19 as well. Haven't filed 2020. So we're paying some taxes here, right? We're paying a little bit over $51,000 in taxes for these couple years. What if, though, in 2020 we have this loss? We can now amend the tax return after we post this 2020 loss to zero out the income and get this full $21,000 tax refund. So this is a way, again, to increase the cash flow, because prior to this CARES Act, that $100,000 loss in 2020 could not be used to go back. So this is another example of how we can use losses in situations to be able to get us refunds. So what I just mentioned was C Corps. So these are the businesses that pay their taxes on their own, and they don't flow through to us as individuals. What if we do have a flow-through entity? What if we do have an S Corp or an LLC that's maybe taxed as an S Corp or a partnership? Under the prior law, there were losses that we would not be able to take depending on what our income is. These losses now have been eliminated. So any losses that you've had for 18, 19, and 20 are now deductible. So again, if you go back to 18 or 19, if that's already been filed, and you had losses that you couldn't use, those returns can now be amended so that you can take the losses, hopefully generate a refund, or at the very least, reduce the amount you owe, and allow you then to be able to get this refund. So again, what Congress was doing here, in a very bipartisan and very overwhelming fashion, try to get extra money into individuals and businesses. And I would say that the businesses really won here because of a lot of the planning that we can do as business owners that individuals necessarily can't do. And here's another one, interest paid. Any C Corp that paid interest before, 30%, limited to 30% of your income, now it's up to 50%. And again, this may not make a huge amount of difference, but as this example shows, it can make a little difference. So here we have ABC, has a taxable income of $15,000 prior to any interest. And so in the prior law, 30% of that, or $3,000, could be deducted. In this case, it paid $5,000 of interest expenses, so $2,000 we couldn't deduct. Now, after these CARES Act changes, we can deduct the full amount. And I've seen businesses where interest can be a very, very large expense. And so if we have a 2018 amount, let's say, of interest paid, we can go back and amend that return and bump up the amount of interest that is deductible. So again, amending tax returns is going to be a possibility here, definitely for business owners. Other individuals and the charitable donations applies to businesses as well, but this is something that isn't really publicized, and at least in a lot of the articles that I read, they didn't even mention this, but for most individuals, you have to itemize your deductions in order to claim a charitable deduction. But in 2020, there's an exception to this, and that is I can still not itemize. So let's say that I'm single, I can take the $12,200 standard deduction. Maybe I don't have any mortgage interest or much in taxes or whatever. So I take the standard deduction, but I can also take an extra $300 deduction for any cash donations that I made. So in a normal situation, I would lose this, but let's say I gave $300 to a church or to a other nonprofit. I can now take that $300 on top of the $12,200 and now really get a standard deduction of $12,500. So if you don't itemize, we can bump up the amount by this $300 deduction. Here's where things get even more interesting for individuals who do itemize. And this is a really, really big issue in that the prior law said that our Schedule A deductions, when we deduct charitable donations, could not exceed 60% of our income, our AGI. So if we look at 2019, we made $100,000. We could then deduct up to $60,000 of charitable donations. And if it was more than that, we could carry it forward. So let's say we deducted a full $100,000, or we donated $100,000 in 19, we would then be limited to the $60,000, and the other $40,000 would go forward. For 2020, the CARES Act eliminated this. So the 60% limitation has been removed, and now there is no limitation. So how does this play out? Well, we can effectively eliminate our taxes in 2020 by making qualified charitable donations. So let's look at this particular hypothetical taxpayer. So in this year, we get to December 31st of 2020, our adjusted gross income is $200,000. And we look at our Schedule A deductions, and this is where we have our medical expenses, our mortgage interest, our state and local taxes. These different deductions come into play. But in this particular taxpayer, I can go ahead then and fully offset all of my adjusted gross income and, in effect, make my taxable income zero and pay no tax. Now, of course, I have to donate pretty much all of my income here to charity, but by doing so, I can then eliminate tax on about $7,900, because in the past, my charitable donations would be limited to 60% of the AGI. And so you can see here that by giving everything to charity, and not that I'm recommending that as your tax plan, but something to look at, we can get rid of a $7,900 tax bill in this particular case by giving everything to charity. C corporations also benefit. Previous limitation of 10% has now been bumped up to 25%. As far as other corporations, S corps or LLCs, these entities go to their particular owner. So I can go back to this prior example, and if the S corp, let's say, made donations of $175, and that flowed through to me on a K1, I could have the same effect. So the C corps have this a little bit different break. Really the big break is going to be for the individuals. All right. Let's look at retirement planning, because there are quite a few differences here as well. Required minimum distributions. The prior rule was that by age 70 and a half, you had to take a distribution from your IRA. Now, this did not apply to a Roth IRA, but it did apply to any other IRA. And also you get into some 401ks and other types of plans. Now, the Trump tax law changed this rule from 70 and a half to age 72. And the required minimum distribution is a taxable event. So the government is trying to force you to take distributions and pay taxes rather than having all that money build up tax deferred in an IRA. This year, though, the CARES Act said that even if you were required to take an RMD, because now you're at least age 72, you do not have to do that in 2020. So no required minimum distribution is required here, I guess, for the lack of a better way to say it, in 2020. Which plans qualify? Well, I mentioned the IRA, get into some defined contribution plans, 401k plans, but basically if the plan requires an RMD, then these plans also qualify for the deferral of that. Other types of possibilities here on your 401k loans, these used to be $50,000 maximum, or 50% of the amount in the account. This has been doubled. So now if you have, let's say, a couple $100,000 in a 401k and you need to take a loan out, you could take out a full $100,000. If you have, let's say, $80,000 in your 401k, you could take an $80,000 loan out. And also, instead of getting 5 years to repay the loan, you now get 6. Now, understand too that as far as the loan limits and everything else here, you still have to go through your 401k. You still could have tax issues if you don't repay them. And also, by taking a loan out, you no longer get the tax deferral portion of the interest or dividends or capital gains that the investments are making. So this is a situation where if you need to do this, it's become much more doable, much more valuable as far as what our options are. Other retirement plan opportunities. In general, if you take a distribution from a retirement plan prior to age 59 and a half, you're going to get hit with a 10% penalty. Now, the IRS is waiving this penalty. So in the past, there were certain exceptions to it, sometimes some hospital bills, they've had education expenses, adoption, a bunch of different things have popped in and out as waivers of this penalty. But the CARES Act for this year, and it's retroactive to the beginning of the year, says that there is no penalty. What does this mean? Well, it means basically that income taxes are going to be due on this, but not the 10% penalty, as long as it's a COVID-19 related distribution. So if we look at what is this COVID-19 related distribution, what that means is that, let's say I was personally diagnosed with the virus, a spouse of mine or a dependent of mine was diagnosed with this virus, or we now start looking at these other or. Now we're having our work hours reduced. Now we can't get childcare. Now we're experiencing adverse financial consequences, closing or reduced hours or other factors. But I think when you look at the first bullet point, unless we're not experiencing any adverse financial consequences, and maybe you're a company like Zoom or Amazon or something that has seen their revenues actually increase during this particular economic crisis. But for most of us, I think bullet point number 1 is going to allow us to use this exception. And here's how it plays out. Lou was laid off from his job. He takes out a $50,000 amount from his IRA. Here's his calculations. He gets hit with income tax on it. And let's say Lou has other income or whatever, but he's going to pay this $12,500 income tax, but he won't pay a $5,000 penalty that he would have paid if this provision was not in play. So even though it's not a good situation, because obviously Lou's laid off, he doesn't have the income coming in, he's having to pull money out of an IRA, which is, again, not a good financial plan. But in this particular situation, he had to do it. And let's not make matters worse by hitting him with another $5,000 of a penalty. Other issues with this as well, if we're in a situation like Lou here, we can repay this amount of any of the distributions, and we can repay it during a 3-year period beginning when the distribution was made. So if I took a distribution, let's say on July 1st of 2020, I could then repay the amount into my IRA by July 1st of 2023. So I get this 3-year window to pay it. I don't have to pay it back, but I can. So what's the benefit there? Well, it would allow me to get the money back into the retirement plan so that we could then get this tax deferral to work and eliminate taxes until we take another distribution. I have not seen anything in here that tells me that the penalty would be removed, though. So again, I don't know the answer to that specific question, but I haven't seen where if you repay it, you get the penalty waived as well. So I don't know the answer, but at this point, I would expect to get stuck with the penalty, or excuse me, with the taxes on that when you paid it. So if we go back to this situation with Lou, he withdraws the $50K, has to pay $12,500. If he repays the $50,000 over 3 years, my understanding is that he's still going to owe the income tax, the $12,500. He won't get that back. He just won't owe the penalty. All right. As far as the distribution goes, then in this case, Lou could decide that he's going to have it all taxed this year, or he could split it into 3 equal amounts in the next 3 years. So again, this gives you an income tax planning opportunity. Looking at this situation here, Maggie's 30 years old, she's unemployed, she withdraws 30 grand from her IRA. She's either going to get taxed on this all in 2020 or 10,000 in 20, 21, and 22. So either way, she's going to get it all taxed, but in either way, she's not going to owe the 10% penalty, but Maggie gets to make the decision. Now, it may not make a huge difference, but again, it's up to her. Now, in a lot of situations, in the case where, let's say in this one, option number 1, example 18 here, but where she's going to tax the whole amount in 2020. This typically is going to make sense because most people hopefully are going to have better situations in 21 and 22 than they had in 20, given the high unemployment and whatever. So if the income is low in 20, let's have it all taxed there. So looking at this situation, made $300,000 between the 3 years and is going to pay $54,000 in tax by having it all taxed in 2020. Let's look now if she decides to split it. And so in this case, still makes the same exact $300,000 over the years, but instead of paying $54,000 in tax, she's going to pay $56,000. So either way, Maggie has this choice. She can pay $54,000 or she can pay $56,000. And I think you can see that if the numbers get quite a bit bigger, the taxes due can be quite a big difference. But the $2,000 taxes, whether you pay it or not, it's your choice. Do you want it or do you want to give it to the government? Couple last points here, and then we're pretty much done here for the CARES Act for tonight. Medical payments. Over-the-counter medication was not permitted to be used in some of these different health plans. Now it can be. So we don't need a prescription from a doctor that says aspirin would be beneficial to your health if you take one every day, or whatever the over-the-counter meds may be. So if you have a health savings account, if you have reimbursement accounts, the medical reimbursement, the 105B plans, the flex plans, the Archer plans, the HSAs, any of these types of plans now permit more types of expenses to be used by the plans. So again, gives us many more planning opportunities, just in the sense that we know what we can do and what we can't. And I think that's what really brings us to, I think, being able to fully utilize the CARES Act to the most of our advantage. Potentially, we can go back to 2013 as far as timing options with this law, meaning that we can look at our 2018 return and go back 5 years on a C Corp. So potentially, tax planning can go from 2013 up to 2020, and then also into 21 and 22. So we have about a 10-year window here of what this tax law can affect depending on who we are. You know, are we a person? Are we a business? Are we married? Are we single? How much income do we make? Are we retired? All these different things come into play. So again, consider the timing options. Look at everything that you've done in the last few years, certainly 18 and 19 at the very least, to see, is there anything that the CARES Act permits that the prior tax law did not permit? And if it does, let's look at amending the tax returns. Let's understand that these losses and these carrybacks may really come into play. Also understand that the tax credits are available and they can be refundable. And I think, again, I mentioned the Toby Mathis webinar. Anything that you do with the CARES Act has to be coordinated with other governmental programs. So if you're getting unemployment assistance, loans, the PPPs, any of these different programs, make sure that you understand how these programs work relative to the CARES Act. And my final point in yellow here, be flexible. If this isn't enough for you, there's more to come. And I just can't tell you what that'll be. But, you know, I think when we have CARES Act 2, sometime this fall perhaps, and again, I'm guessing, but I'm thinking that could happen, I'll be ready with another presentation, hopefully by that point, to explain what's going on. And maybe we also have more guidance here on what I've discussed tonight. So flexibility is really important, and staying up to date and on top of all these changes that are coming about is also very important. So anyways, I'll grab a few questions now before I conclude for the night. But that is the extent of my presentation, and certainly want to thank everybody for listening. If you don't have a question or don't want to stay for the Q&A. So I'll throw it back to, I guess, Don and Dan or Kendall to see what sort of questions we have.
Okay. Scott, awesome. Thank you. Okay, so we do have a bunch of questions coming in. So let's start with Eric. He said he received an EIDL loan approved by the SBA under 10,000. He thought the first 10,000 was a grant, but the terms include a payback period. Will I have to repay the small loan that he received?
Well, I think that's where you get into coordination with the other programs, and a lot of them that require loan repayments, and some of them are forgivable types of debts, that they don't permit a coordination with the CARES Act to be able to do both. And I think that's really the big issue, as far as you want to make sure that you don't end up getting like a loan where you're paying back and then also don't qualify for some of these changes. So that, again, that's going to depend on the type of the loan and how it can be coordinated.
Right, but that was very deceptive, I thought. I thought it was very deceptive in that at first it came out and it was going to be a grant to all small businesses, and then it ended up, well, it's really just a loan, but it may be forgivable under certain circumstances. But I thought the whole layout was, well, I don't know if it was deceptive or if they just changed the rules midstream. Any ideas on that?
Yeah, it's hard to say, Don. I think what happened, I'd like to give everybody the benefit of the doubt and say it wasn't deceptive, but I think they came out with this so fast that they didn't consider the unintended consequences, or what would happen if, you get the loan and it's forgivable or it's not forgivable, or we don't know for 5 years if you're going to get it forgiven or not. And then we've got to coordinate with these CARES Act provisions that came out completely separate from what they were doing with the loans. And so you get all these conflicting provisions here. And what I've tried to tell people is to try to get to somebody that can look at your situation. So, if you get the education from a webinar like tonight, and also the one that Toby did, you put those together, we still have to be able to figure out how are we going to do this for you as an individual, right? This is just, general information as far as what the law says and how we can play around with it. But how are we going to maximize it for an individual basis? I think we've got to look at it, because, like you said, it's confusing.
Yeah. All right. Bart is saying, I thought the mortgage interest plus the state tax deductions were limited to $10,000.
The $10,000 limitation is only on the state taxes. So the mortgage interest can be in excess of that, but they did put a cap on the mortgage interest, and that is it's only for mortgage interest on loans up to $1 million. So if you have a loan for more than that, there's going to be a cap, but the $10,000 cap does not apply to the interest.
And second mortgages may or may not be deductible. But no, the $10,000, as I read it, was only on your state, but state and your state and local taxes. But that could be huge if you live in a state with large property taxes or large income taxes or both. That's a big cap for a lot of people.
Well, yeah, it's a huge cap. If you take somebody in California that is making, let's just say $100,000 a year, they may pay $10,000 in taxes to California plus property taxes plus, and now all of a sudden you're at $30,000 of taxes and you get a $10,000 deduction. So as the question the gentleman pointed out, yeah, that 30,000 would be capped at 10, and you lose the other 20. And unfortunately, the CARES Act did absolutely nothing to change that. There's legislation in process that if there is a CARES Act Part 2 or whatever, that's one of the things that they're looking at. But right now, there's a big disagreement in Congress as to whether that should be changed or not.
Okay. David is saying, if I pulled 10 or 100,000 out of my 401k plan under the CARES Act, deposited into my personal account, then chose not to use it, and I wired it to a self-directed IRA, will there be a problem with that? So he's not rolling it over, he's taking it out of the 401k and then putting into a 401k or into an IRA.
Well, then you still get the situation of, as long as you're doing the rollover, right, within the 60 days, then it's not a distribution for tax purposes. I would always advise people, though, if you are going to make, you're going to take a 401k and put it into an IRA, I would do the direct rollover here, go custodian to custodian, and then you never touch the money. But if you are going to touch the money, you got to make sure that you don't have it be a taxable distribution.
Correct. Good. Joyce, for a C corporation sole proprietor owner, are reimbursable expenses used to determine the payroll amount? A C corporation sole proprietor owner, I don't know whether it's a C corporation or a sole proprietor.
Yeah, I'm going to read that as we have a single person, like 100% owner in a C corp.
Okay.
And that's what it say, our owner reimbursed expenses. No, the payroll amount is going to be only for wages paid. So if you have, let's say that you had $100 worth of meal expenses on a credit card that the corporation reimbursed for, that would not count. The only thing that I've seen that counts would be the health insurance associated with the wages. And so if that is reimbursed from a C corp, then then those, I guess, could be, but again, not your typical expenses. And I guess the other way to look at it, Don, if this was a sole proprietor, then these would be used as far as the self-employment taxes go. But again, it would be a reduction of self-employment tax, not as far as the reimbursable expenses.
Okay, good. All right, Jenna, what are the penalties for early withdrawal if my IRA is partnered with an LLC and you plan to liquidate the IRA?
Well, how the IRA invests doesn't really matter from this IRA distribution standpoint. I mean, if you're gonna liquidate an IRA completely, then the entire amount that you liquidate is a potential distribution here, and you could be penalized on the amount. But the good part about this is that the IRS has eliminated the 10% penalty this year. So let's say that you have you have $100,000 in your IRA and it's partnered with an LLC to do whatever, and you decide that you're going to liquidate that. The $100,000 that comes back to you ordinarily would be subject to a 10% penalty, or $10,000. That penalty has been waived, but the $100,000 that comes back to you is still taxable income. So even though there's no penalty, there's still income taxes. And that's the part that you have to look at. So don't look at what the IRA is investing in, but look at the distribution to the IRA owner. And that's where the taxability issues come in.
Okay, good. Josh, information I received from my federal TSP said if an early retirement distribution was to be paid back in 3 years, then no taxes are due.
Yeah, that would be helpful because I haven't seen that as far as the technical stuff. So that one I will look up again because like I said, I wasn't able to see that.
Okay, good.
So what the question is saying is, look, as long as you take an early retirement, but you pay it back within 3 years, then you don't have to pay the taxes on that distribution. And if that's the case, then what we would probably have to do is amend the future tax returns to take the taxes off. So in other words, if I had a $20,000 distribution this year, I'd have to report it on this return, and then if I paid it back, I'd have to somehow amend it. And that's the part that I didn't see before, so I don't know. Again, what this gentleman is saying is that if you pay it back, you don't have to pay the taxes on it. I haven't seen that yet.
Yeah, and John's just saying it's right on the TSP website. So
yeah, so that's good. So we can look that up pretty easily. That's good.
Good. Okay, we've got less than 10 minutes. Let's answer as many questions as we can. With a 401k loan and it's paid back over 6 years, are there any tax consequences?
No, as long as it's repaid in full, it would be just like any other 401k loan. The benefit now is that instead of borrowing $50,000, you can go up to 100, and you can go or up to 100% of what you have in your 401k. So as long as you pay everything back, there's no taxes due. If you don't pay everything back, then the loan can become a taxable distribution.
Now, Scott, let me ask you, because this has messed up a lot of people. Are there quarterly payments due? Let's say I take $100,000 out. Do I need to be making quarterly payments, or as long as I pay it back somewhere, lump sum within that time period? How does that work?
Correct. Say you take out a $100,000 loan, there would be a repayment provision in the 401k plan that would tell how that works. And so you can pay it back with interest to yourself and whatever, but it does not have to be quarterly. It could be however the plan loan is written. So it could be lump sum after, in this case, it could be after 6 years, not 5 like the prior.
Good. Okay, Dr. Ken, good to have you on. In your estimation, how many pages are now contained in the U.S. tax code as of 2020? Too many.
Yeah, that's a real easy answer. Way too many. As I've said before, most people don't need sleeping pills or aids to sleeping. Just read the tax code, right? That'll take care of it for you. But we're way over 100,000 pages. So there's plenty of opportunity there to get some real stimulating reading in.
All right, and a couple people have asked how they get access to Toby's webinar. Kendall, maybe I'll have you chip in on that, because I think we keep them on our website for like 30 days for free, and then after that, how does that work, Kendall?
Yeah, just send me a link, or send me an email, and I can certainly send you a link if you don't have that. My email is kendallb, it's KENDALB as in Bravo, at protectwealth.com. Happy to send that out to you, and I'll put that on the chat screen.
Okay, good. Joel, asking if this webinar is being recorded. Yes, it is. Kendall, let me refer back to you. When will this be available, the recording of this?
Yeah, it just generally depends on when the recording gets done, and sometimes it's an hour and sometimes it's 4 hours, and then I have to have it sent out. So watch for it sometime tomorrow afternoon.
Okay, there we go. All right, how far back, Judy is asking, can you amend a personal or business tax return?
As far as the regular amendments go, it's a 3-year process, right? So you can go back 3 years on any business, any personal return, and amend it. The 6-year difference comes in, or in this case 5 years. They've had all these different periods, but the 5 years comes in on a net operating loss carryback. So what we really are doing there is we're amending the 18 return to carry the loss back to 13, and in effect amending the 13 return. But the 5-year provision only on loss carrybacks, otherwise 3 years controls.
And that's 3 years from the date that you filed the return. Is that correct?
That is correct. That is correct.
So if you filed late, you might be able to go back, but 3 years from the date that you filed. Okay.
Correct. Yeah, I mean, when you start getting into late filing and refunds and everything, there's a 3 years from the date that the return was due, 2 years from the last payment, all these different types of issues that come into play. But yes, general rule, 3 years on amending. Good.
And Joel is saying, does the CARES Act help folks who always have passive loss limitations?
That's a great question, and it does not. That was something actually I looked at because I'm in a situation a lot like Joel as well, where basically the tax law says that passive losses can only be used to offset passive income, and there's some exceptions for real estate professionals and what have you, but that's the general rule. The CARES Act did not change anything with passive losses. What it did do, though, is it eliminated what was called excess business losses for 18, 19, and 20. So even though they're not technically passive losses, they do allow S-Corp losses now to be used to be able to offset other income as long as the S-Corp losses were active. So nothing on the good side came out of the CARES Act as far as the passive activity losses.
What if they were then a real estate professional? Can we go back? Does that change? Things?
Yes, it potentially could, because on a real estate professional, you could have a big enough loss that would permit you to carry the loss back. Because again, the difference between a real estate investor and a real estate professional is that the real estate professional is in business, where the investor is not. And so there's many more opportunities for the real estate pro than there is for the real estate investor.
Good. All right, we're getting some nice thank yous. We appreciate that. One more question, and then I know Scott has to go. And that is the last question. Isn't there no payments due on the first year? I suppose if you wanted to pay it off early, you could.
Pay off what early? Pay off the loan, or?
I'm assuming it's a 401k loan or an IRA loan.
The 401k loans really they haven't, if you think about the loans themselves, they haven't changed as far as what the basic rules are. What they did change is the amounts and the repayment period. So basically you can look at it and say, I can take 100K out or 100% of my balance, whichever is less. So that's number one. Number two is I have 6 years to pay it back rather than 5, and I can pay it back whenever I want in that period. So, if you take it out today and a month from now you can repay it, in my opinion, that's the best of all possible worlds, because you're getting the money back into the 401k, and now any interest, dividends, cap gains, anything that it makes is all going to be tax deferred, rather than you taking the money out and then getting those taxes in your personal name and having to pay taxes this year on it. So, but you always have the opportunity, again, based on the loan provisions in your particular 401k, to pay it back when you want, within the 6 years, I guess.
Okay. And Waylon is talking about, you know what, yes, this is being recorded, and it should be sent out to anyone who registered. And you're welcome to share that link. If this is helpful to friends or family or business associates, you're welcome to share the link. Scott, so appreciate your time and your expertise on this webinar. And Scott, we will see you in Phoenix, and Scott will be one of our presenters. You get a chance to sit down or ask questions with Scott, but Scott will be in Phoenix and in Orlando, our next 2 upcoming summits. Look forward to that. Scott, any closing remarks before we go for the day?
Just thank you very much, Don. Always my pleasure. And I just hope that, I can, as we get further in this and things become a little bit more clear, hopefully we'll be able to really maximize the planning down the road at those different live events. But it's always been my pleasure to be able to host one of these events for you and be a presenter. So thank you.
Scott, thank you. And for everyone listening that's still on, we appreciate you being here tonight. Stay safe, stay well. Hopefully we'll see you soon at a summit. Thank you for joining us. Have a great night.